Okay, in this last video for financial literacy, we're going to be talking about what's meant by superannuation. So superannuation is a compulsory form of savings for retirement, where basically employers place 9.5% of employees' wages into a range of different investments. And you can't access that money until you retire, so it is your money. It is money that your employer has contributed on your behalf, but you can't access that money until retirement. Currently, 9.5% of employees' income goes into superannuation, and that money is invested in a range of different investments. So some of it goes towards shares, so both Australian and overseas, into property, into various savings accounts, bonds, and other forms of investment. In terms of superannuation funds, there's a range of superannuation funds you can invest in: conservative, growth, balanced, and cashed funds. So in terms of a growth fund, basically a growth fund means that most of your superannuation is invested into higher risk assets like shares and property. So they aim to have a higher average return over the long term, but it also means they generally make higher losses in bad years. Because property and share prices are more volatile than just putting your money in savings accounts, it's likely to see that you will have bigger gains but also bigger losses if you invest in growth super funds. So you may be able to invest in a high growth option with 100% in shares and property, and this would be even more risky and more likely to go down in a downturn in economic growth. Balanced funds invest around 70% of your superannuation into shares or property, and the rest into sort of fixed interest and cash. So basically it aims for reasonable returns but less than growth funds, but it does reduce the risk in bad years. So because 30% of the money is in interest and in cash funds, that means that they're not likely to go down when you experience an economic downturn. So losses usually occur less frequently than in growth options, which means that you're less risky, but you're also likely to generate a slightly lower return. Conservative funds is around 30% in shares and property, and the rest is in fixed interest and cash. So this is a very risk-adverse option. It aims to reduce the risk of loss, but therefore you accept a lower return. There's less chance of having a bad year, but also much lower chance of having a good year or a really strong year. And then cash, which invests 100% in deposits with Australian deposit-taking institutions. That basically means it's like bank, and they basically it's a guarantee that you're going to earn a set interest rate, but it means that you're not going to make massive gains, but you're also never going to make losses on your investments. So the four types are growth, balanced, conservative, and cash. Growth being the most risky with the likelihood of the highest returns, then balanced, then conservative, and then cash, which is completely risk-free with lower returns. Two other things you need to be aware of in relation to superannuation is what we call employer contributions and a defined benefit scheme. If your employer pays you employer contributions, that's when they put 9.5% of your income into superannuation, and that grows each year and accumulates as share prices rise and you collect interest on savings. So in that case, you take the risk. They put 9.5% of your income into superannuation, and then if shares and property aren't going well, then your value of your super can actually fall. If you've got a defined benefit scheme, that's a little bit different. That basically means that the employer or sponsor promises a specified pension when you retire. So at retirement, there is a predetermined formula as to how much you're going to receive for superannuation. It's generally based on your earnings in your final year and how long you've been in service to that job, as well as your age. But it doesn't, basically what it means is that they calculate your earnings when you retire and multiply that by a set amount. So you might be on 100,000 in your final year of work. So your defined benefit scheme super would basically mean that the super might be that you earn 8 times whatever your income is in your final year. So you might have an income of 100,000, so your superannuation would be equal to 100,000 times 8. So if you have a defined benefit scheme, it's just multiplied by whatever you earn in your final year. So again, if you earn 100,000 in your final year, they would multiply that by 8. That's how a defined benefit scheme works. Why did superannuation go down during the GFC? Well, a large percentage of your superannuation is invested into both international and domestic shares and property. So the GFC caused property prices to fall and share prices to go down. So what happened is many citizens lost their job because of the economic downturn, and then companies were receiving lower sales, lower revenue and profits, and therefore that led to significantly reduced amounts of wealth people had in their superannuation. So basically, because there was more unemployment and because there was less spending in the economy, share prices went down, and because a lot of people have invested in shares within their superannuation, people's superannuation also fell. A self-managed superannuation fund is the last thing you need to be aware of. A self-managed super fund, or SMSF, is basically where you manage your own super. So you decide where your money is going to go. It's a major financial decision, and you need to have the time and the skills to know what you're doing. So the main advantage of a small self-managed super fund, is that you don't have to pay fees to a super company to manage your investments. So fees can be quite expensive, but the negative of that is that you don't get to run your own superannuation. So you have to run your own superannuation, make all the decisions, and that can be quite time-consuming. Thank you.